Well, good afternoon and welcome to our monthly live training. My name is Alexandra Batista, and I am a finance and loan analyst with the Lender and Partner Activities branch. We are excited to share some of our loan programs with you today. So let's go ahead and begin. First, I want to begin to share how the Guaranteed Loan Program came to be. In 1991, USDA Rural Development began partnering with lending institutions to offer affordable home mortgages in rural America. Today, we have over 3,000 lending partners nationwide to help with rural America successfully achieving their dream of homeownership through the Single Family Housing Guarantee Loan Program. The agenda for today will be reviewing the following loan programs: the Single Close Construction Loan Program, our Rehab and Repair Loan Program, and the Manufacturing Housing Loan Program as well. But first, our mission and goals. Again, before we begin, let's take just a minute to go over the vision and mission of the Single Family Housing Guaranteed Loan Program. We strive daily to create efficiencies and cultivate partnership with lenders and stakeholders to work together in order to strengthen and expand the program to benefit rural communities. This allows us to always keep focused on our mission, which is to provide affordable and sustainable home ownership opportunities for low to moderate income households in rural areas, and offer the opportunity of homeownership that they may not be afforded otherwise. Recent data shows that with the current market conditions, there is a lack of affordable housing stock in rural areas, which has pushed many low to moderate income households out of the buyer's market. USDA offers some affordable purchasing alternatives that will help you to provide your applicants with options that can help the dream of homeownership come true. Here, let's take a look on how someone can qualify for the USDA Guaranteed Loan. There are two primary criteria: income and location. The property being financed must be located in an eligible rural area, and the total adjustable annual household income cannot exceed the 115% of the median household income for the area where the property will be located. Now, while these criteria may sound like restrictions, they are not as restrictive as you would think. Do you know that over 92% of the U.S. landmass is in an eligible area? And from the latest census data, about 4 out of 5 U.S. households fall under the 115% median household income requirement. That's a pretty significant portion of the population who could benefit from this program, and a considerable amount of potential clients for you as well. So before we get into our loan products, I do want to point out how our Single Family Guarantee Loan Program stacks up against other loan products that you may be familiar with. As you can see in this chart, there are several other similar loans available. There are also some notable differences, the biggest being the down payment. Our program offers 100% financing up to the appraised value with no down payment required, with the VA being the only program offering the same. Now let's talk about fees. The Guarantee Program does have a minimal fee that keep our programs subsidy neutral and running without taxpayer dollars. However, they are low and very affordable by comparison. Our upfront guaranteed fee is comparable to those other products with upfront fees, but an added benefit of our program is that the 1% guarantee fee can be financed in the loan amount. Our monthly annual fee is also low in comparison to other programs that require a monthly fee. Ours is only 0.35% and is based on the average scheduled unpaid principal balance. And as you can see, some products are more restrictive with their income limits serving only those low-income applicants, whereas our income limits are at the moderate level income. So comparing these programs, our guarantee program is a strong, viable option for a lot of potential homeowners or home buyers. The program allows for most types of available housing in rural America. Existing properties must be single-family residence. We do not allow multi-unit or income-producing properties. We also offer funding for new construction, modular homes, which are treated as stick-built homes, townhomes, condos, or a new manufactured home. Existing manufactured homes have a manufacturing date that is within 20 years from the loan closing date. A single unit in a duplex is also allowable when the duplex unit are separately deeded. So let's go over a few of these unique offerings. All of our loan products that we are going to talk about today follow the same program highlights and benefits. We provide 100% financing up to the appraised value. In the case of a single closed construction and rehab and repair product, we would lend up to 100% of the as improved value. And our 1% upfront guarantee fee may be rolled into the loan, making the total loan to value 101% of the appraised value. There are no maximum loans or sale price limits with our program. The loan amount is based solely on the applicant's repayment ability and credit qualifications. And contrary to popular belief, our program is not limited to first-time home buyers. And in some cases, applicants who currently own a home may qualify for a guaranteed loan as well. Let's begin with our single closed construction product, which is covered in the handbook, chapter 12, section 6. Along with the ability to fund regular new construction projects, we also offer a single closed construction program to aid in improving the supply of affordable housing in rural America. As the name suggests, it's a single closing, meaning one set of documents to spare extra time and unnecessary costs. The single close process was designed to protect all participants, lenders, builders, and buyers. The single close construction loan product combines the short-term interim loan, which is obtained to finance the cost of construction with a traditional long-term permanent residential mortgage loan. We have all been feeling the effects of the current market, especially in terms of the lack of inventory available for buyers, and there aren't a lot of options out there, but using the single closed construction loan feature, this might be a great option to build your home the way you dreamed of. So what are some of the buyer's benefit of this product? Well, first, there is only one closing required for this construction loan, saving the home buyer time and money. The borrower will have a more comfortable experience since they will already be in a fixed rate that is locked up front. We also allow for up to 12 months of principal and interest or PITI payments to be rolled into the loan amount, eliminating the need for the borrower to make 2 housing payments during the construction period. Along the same lines, the product also allows for a contingency reserve up to 10% of the purchase price to fund unexpected cost overruns and protect the borrower from additional out-of-pocket expenses. The loan can also include the cost of acquiring the land or paying off any balance on land that may be already owned by the buyer. The single closed construction loan also allows for remaining reserves to be applied toward the principal balance once construction is complete. New construction offers homeowners less maintenance than what is often needed when purchasing an existing home. These maintenance benefits also represent a better credit risk for both the lender and the agency. Another great selling point, realtors and lenders' commission are paid at closing. No need to wait until construction is complete. This is a rare realtor benefit for new construction loans because they can receive their commission from the sale before the house is even built. Just like buyer benefits, the single close construction provides some great lender benefit as well. Perhaps the most important is our loan note guarantee gets issued at loan closing before a shovel goes into the ground. The builder is also protected since the full build is funded at closing. This means if something should happen and the borrower is unable to fulfill their obligation before the house is built, the lender will still work with the builder to complete the construction as initially approved. Once complete, the lender would then sell the home, and if any loss was occurred, they can't submit the loan note guarantee to the agency for reimbursement. Builders, especially those smaller businesses that are found in rural areas, are provided with the benefit of not having to put up their own capital for construction, since the new construction is funded at closing and protected by the loan note guarantee. The originating lender may sell or retain their servicing rights immediately after closing. Additionally, since the loan note guarantee is issued at closing, the lender has the ability to sell on the secondary market after closing before construction even begins. There are two options available, the standard interest only and the securitized. Let's look closer at those. Securitized versus interest only. Both options set the interest rate, along with any contingency reserve of construction costs and any payment reserve of up to 12 months. At signing, the agency's loan note guarantee is issued and put into effect, protecting the lender and the building process. Here's where the differences comes into play. With the standard interest only version, the interest only payment begins during construction and at the completion of the construction. After any excess reserve are applied to the principal balance, the loan modification will happen. The loan may be reamortized to achieve full repayment for the remainder of the loan term. Now with the securitized version, excess contingency funds are also applied to the principal balance, but there is no modification or ream needed. Since regular payments have been made from the start, what this version accomplishes is the ability to securitize the loan immediately, eliminating the need for the lender or the builder to maintain a warehouse line of credit during the construction period. This product and its process were designed to mitigate risk and encourage affordable new construction. So lender qualifications. So how does a lender qualify to participate in the single close construction product? Well, they need to be an approved lender in the Single Family Housing Guaranteed Loan Program. Once approved, lenders can self-certify that they have staff with 2 or more years experience making and administering single-family housing construction loans. As another option, lenders may employ a construction management company with 2 or more years experience in lieu of in-house staff experience. Once the lender signs up to partner with our single close construction product, we will include their contact information on our Single Family Housing Guaranteed Loan website so that potential borrowers and builders may reach out to the lender support in their prospective areas. So here's some lender responsibilities. The lender does have some responsibilities when it comes to the single close construction loan product. However, all are very similar to what can be expected on any other construction loan, which involves monitoring the construction process, approving any change orders that would be associated with the build, while also monitoring the reserve account or warehouse line of credit if the standard version is used. Lenders also confirm the eligibility of contractors, builders, and a loan management company if you're going to use them. All documentation used in determining the eligibility of those entities must be retained in the lender's permanent loan file. Now, builders' responsibilities. Let's take a look at the builder's requirements. Contractors or builders must have a minimum of 2 or more years experience in single-family housing construction and must be licensed in the state in which the home will be built, as well as have a minimum of $500,000 coverage in commercial general liability insurance. Any contractor who wishes to build their own residence would not be eligible. I do want to make a note that that the requirement for the builder's background check was removed as a requirement in November 22. All loan costs that may be included in the loan amount are subject to the maximum allowable loan to value and must be reasonable and customary construction cost. Some of the allowable costs are noted on this slide. Funds may be used to purchase land or pay off any balance on land already owned where the home will be built. Funds may also be used to cover hard costs that are associated with the build and third-party expenses, such as a well, driveway, and utilities, or even landscaping. Construction soft costs may be an eligible use of the funds. These would include your inspection services, survey, permits, administrative fees, as well as any payment or contingency reserves. The cost to construct must not include items such as furniture, home entertainment equipment, or other personal property items. So one of the key elements in maximizing the final market value of the proposed build is to provide your appraiser with all costs that will be associated with the construction. You want to ensure that your appraiser is provided with the cost or value of the land, all construction hard costs, as well as all soft costs that will be involved in the build. This will allow your appraiser to complete a more accurate assessment of the value of the property, which will be used for the loan. When it comes to new construction, stick-built homes documentation, we have options. And the lender is responsible for obtaining one form of required evidence from the list of available sources, source option in each category. This evidence must be kept in the lender's permanent loan file. As you can see here on this slide, there are 3 options available for certified plans and specs, evidence of construction inspection, and thermal standard. Chapter 12 of our handbook provides additional guidance on these in more detail. So new construction in small rural areas can open up numerous benefits that are vital to community growth and sustainability. The increase of new dwelling increases the local community or town's tax base, which can provide additional funding opportunities for federal and state grants and loans. Through these loans and grants, communities are provided with opportunities to make much needed improvements to aging water and sewer facilities, as well as increase utility resources to those who live in these rural communities, such as broadband services. Growing communities are a target for many medical facilities that want to expand their services to meet the need of those who are living in more rural areas and need access to local health care. And as population increases in these growing communities, it provides for an opportunity for small businesses to expand their services to meet the needs of people who live there, which as a result increases the need for additional jobs. In fact, per a report that was prepared by NRCS economists, approximately 12.4 jobs are created in the local community from every $1 million in guaranteed funds. This will then add even more to the growing tax base, and the pattern begins to grow and provide for a solid foundation to enhance the quality of life for those living in these small towns, rural towns, and communities as well. Next up, let's talk about our rehab and repair loan products. Yet another challenge in the current market with the lack of affordable housing is that many existing homes need repairs to be safe and sanitary, and sometimes the repairs are significant. This is the reason for the creation of our rehab and repair loan products. This product is only available with the purchase of an existing home, very similar in nature to single close construction. This product allows for lending up to 100% of the as improved appraised value. So what are some of the benefits of the single close rehab and repair loan products? Well, it also provides for a single closing, allows escrow for contingency funds of 10% of the purchase price, as well as up to 10 months of payday payments in some cases. Most importantly, the loan no guarantee is issued at signing prior to any work being started, making this product immediately sellable on the secondary market. And also, like the single close, it pays the realtor fees and at signing before any work begins. Okay, now we know what great benefits the rehab and repair loan program offers. Let's take a look at property eligibility. First, the property must be an existing property, but what does that mean? This means that the property must be at least 12 months or older. New construction or incomplete construction would not be eligible. If a dwelling must be demolished as part of the rehab process, then the existing foundation must still be in place. Any property where the foundation has been demolished or where only the footings remain would be ineligible. And what are some of the requirements of the rehab and repair? USDA allows financing up to 100% of the as improved appraised value, so make sure that your appraiser receives a complete list of the proposed repair or renovations along with the cost to complete. We allow maximum construction period of up to 6 months. In some cases, such as inclement weather, additional time may be needed. Extensions may be approved in certain circumstances at the lender's discretion. A copy of the fully executed contract must include a construction start and end date, and also be made a part of the security instrument. If any previous unpermitted work is found during the rehab or repair, then the code enforcement personnel must determine the process to permit the previous construction. All permits must be obtained for any new work. We offer two versions under our rehab and repair loan product, just as we do with our single close construction. So it's the structural and non-structural versions. Under the non-structural option, we can finance up to $75,000 in repairs with no minimum repair amount, and with the structural option, it's over $75,000. So non-structural, it's up to $75,000, and structural, we can finance over $75,000. A qualified inspector is always required for structural repairs. However, for non-structural, it really depends on the repair type, but more often than not is not required. So an inspector is not required. Contingencies are allowed under both. 10% contingency is allowed if utilities are on, and 15% if utilities are not on. We also allow for up to 10 months of pity payments to be financed into the loan amount if the dwelling is uninhabitable. Reserves are optional under the non-structural program, since more often than not, the borrowers can move in while repairs are being completed. So there is no real need for the payment reserve. So managing the construction. Originating lenders do not need construction experience if the servicing lender will be administering the construction. Servicing lenders must meet the monitoring requirements as outlined in Chapter 12.13 of our handbook, which we previously discussed under the single close construction product. Likewise, contractors and builders are required to meet those requirements as described under this single close construction product as well. Borrowers are not allowed to act as their own general contractors. The lender may engage inspection or consulting services by any licensed person deemed qualified by the lender. The inspector or consultant may evaluate the property, write up necessary improvements, conduct periodic inspections, and act as a liaison between the borrower, builder, and lender. So what can a buyer use the rehab and repair loan products for? Well, they can upgrade or renovate kitchens, bathrooms, floor coverings, windows, and other similar home features. They may also be used to create accessible amenities for individuals with disabilities. Funds may be used for structural alterations, additions, and even reconstruction. Keeping in mind that any new structures or additions to the existing dwelling must comply with local codes and any applicable national codes. An eligible use of funds would also include the removal of health and safety hazards, installation of energy conservation or weatherization features, or the repair of installation of utilities such as water and sewer. As you can see, this is a great option for applicants looking to purchase a property that needs some TLC or a few renovations to more adequately meet their current needs. So what are some of the prohibited loan purposes? So we reviewed what loan funds can be used for. Let's go over what loan funds cannot be used for. First, it may not be used on any investment properties or any alterations that would allow the property to become income producing. Installation of new swimming pools, saunas, or hot tubs are not authorized. However, a purchase of an existing home that has a swimming pool, either above or in ground, are allowed. Funds may not be used to convert existing structures such as a barn or a church and convert the property into a single-family dwelling. We also do not authorize any repairs to new or existing manufactured homes, condos, or improvements to common spaces such as playgrounds or meeting rooms. And now let's talk about manufactured homes. Our program allows for the purchase of manufactured homes, which is a great affordable option for many home buyers. This is a terrific product when combined with our single close construction loan product, allowing loan funds to purchase land and site development where the manufactured home will be placed on, as well as cover the cost of the unit and transportation. So let's take a look at the unit, the site, and the construction requirements for manufactured housing product. Eligibility of new manufactured home is pretty straightforward. The unit must have been constructed to the Federal Manufactured Home Construction and Safety Standard Code, be less than 12 months old and never occupied, have a minimum of 400 square feet of living space, and be placed on a permanent foundation that meets HUD standards. The placement must be on land owned by the applicant and not rented. There are some restrictions that come with the approval for manufactured housing. First, the purchase of the unit may not be approved without a site. Repairs to the manufactured home are not authorized with a transfer, REO sale, or a unit that is already financed with a USDA loan. Funds may also not be used for furniture or any other movable article of personal property. Any additions or modifications are not authorized except for porches, decks, or other structures that were built to engineered design and approved by local code officials. Additionally, with restrictions, any unit with running gear or a towing hitch would not be eligible for the program. Any unit that is older than 12 months from the purchase agreement would also not be eligible. And finally, the purchase of a unit that is moved from any site other than the dealer's lot is not authorized. And again, this is for new manufactured homes. Now let's take a look at the site and construction requirement as they relate to manufactured homes. First, the unit and site must be classified, zoned, and taxed as real property and must be secured by a recorded security instrument. A licensed manufactured home dealer is required from purchase through the completion of the unit being permanently set on the site. A certification from the dealer and builder stating that the unit was properly joined and sealed and no damage was sustained during transportation is required as well. The permanent foundation that the unit will be placed on must meet HUD Handbook 4960.3G requirements. An itemized cost breakdown of the complete construction package is required along with the dealer certification stating that the processed cost is the full price of the unit. Also, any cash payment or rebate as a result of the purchase of the purchase must be deducted from the price of the unit and not paid directly to the applicant. Now, let's go ahead and review the eligibility requirements for the existing manufactured home. The existing unit must have been built to the Federal Manufactured Home Construction and Safety Standard Code, must have a manufactured date within 20 years of the loan closing date, and be placed on a permanent foundation that meets HUD standards. The existing unit must meet the same criteria as new manufactured homes that we just reviewed, and the home must be free of modifications, with the exception of porches and decks that were built to engineered design and approved by local code officials. Okay, now let's move on to some of the resources available to our lenders. This will be your primary source of, for origination and servicing resources, as well as guides in the USDA link training and resource library page. The link homepage features turn times for conditional commitments. This platform serves as an essential source of information. Additionally, if you have overlooked any significant updates from GovDelivery, you can easily find an archive of past emails available on the site. If you haven't already done so, or if you haven't already remembered to sign up for GovDelivery notification to stay informed, you can also scan the barcode to quickly bookmark the link library page. Our technical handbook, also known as the Handbook 13555, serves to deepen the understanding of the regulation while providing additional insights. Comprising of 19 detailed chapters, the handbook is intended to enhance the 7 CFR rather than replace it. For quick access to essential information, it is advisable to consult both the 7 CFR and the handbook. Remember to bookmark these resources and use the Control F for efficient navigation. Our policy team has created a valuable resource in the form of a FAQ document. This document addresses questions from lenders seeking a clearer understanding of how regulation and handbook policies apply to specific circumstances that they might have encountered. It includes examples and some unique scenarios that illustrate these concepts effectively. We encourage you to take a moment to review this document. If you have further inquiries after examining your resources and tools, we are here to assist you. To obtain the contact detail for the staff of the Single Family Housing Guarantee Loan Program, please scan the provided code in this slide here. You can also reach out for support by directing your questions to the appropriate email address for the guarantee team. And if you are interested in learning more about any of the single family housing loan programs you heard about today, please contact us here at the Lender and Partner Activities branch so that we can set up a training for you and your team. And that concludes our live presentation. Thank you all so much for joining us today. Thank you.